Hi, my name is Waldergrave, and this is Teekay's update on the conventional tanker market for August 2013. Now, the last few weeks in the conventional tanker market, through the tail end of Q2 and into the start of Q3, have been particularly weak. And that's normal for this time of year. This is usually the time of year when we see the really weak tanker rates. And this year has been no exception, really for two reasons, both structural and seasonal. On the structural side, we've seen a continued decrease in US crude oil imports. And that's due to increasing domestic oil production from shale oil, which means that the US is moving less oil by sea into the ports in the US Gulf Coast and the Atlantic coast. And that's been particularly negative for the Suezmax sector, which is the usual type of ships that are moving that light oil from West Africa into the US. What we've also seen is that OPEC crude production has gone down, and that's because the call on OPEC has been lower, given the amount of non-OPEC oil production that's going on elsewhere, and given that demand growth is still pretty sluggish. On the seasonal side, we've seen a very heavy period of refinery maintenance through this spring, which extended into May and the early part of June. And now we're into the summer months as well. We're seeing factors such as North Sea oil field maintenance as well impacting on rates. And that's especially had an impact on the Aframax market. And so across the board on the crude sectors, we've seen rates stay pretty low in that kind of low to mid-teens, $10,000 to $15,000 per day kind of range. And on the product market, it's been a little bit better, especially in the MRs. The Atlantic MR sector has been particularly firm in recent months. And all of that's due to a very strong US refining sector at the moment, and the fact that the United States is sending out a lot of product on MR tankers to Europe, to Latin America and to West Africa. The LR2 market has come off a bit in recent months though. If you remember, the LR2 market started the year pretty strongly at around $15,000 to $20,000 per day. Those rates have come down as we move into the summer months. And a large reason for that has been that some of the vessels which are coated but were trading in dirty products have actually cleaned up and have now entered the clean trades and are trading as LR2 tankers. So that's effectively added to fleet supply and put some downward pressure on rates. Looking to the next few months, we think that the remainder of the summer months and into the rest of Q3 will remain particularly weak. But we do expect that Q4 the rates will improve, and that's due to the normal seasonal factors. In fact, if you look at the IEA's outlook, they're saying that global oil demand in the second half of the year is going to average about 1.5 million barrels per day higher than the first half of the year. So we'll see some better demand. We'll also see some of the normal seasonality that comes in during the winter months in terms of bad weather, vessel delays, that kind of thing. So we do expect that the rates will improve a little bit. But as in the last 2-3 years, we'll probably see that the rates will stay fairly low on a historical basis, but just with some short, sharp rate spikes as we get these weather-driven events. Looking towards 2014, our expectation is that the supply-demand balance will be better next year. And that's because the global economy is starting to slowly improve. The most recent forecast for oil demand growth in 2014 is for 1.2 million barrels per day growth compared to 0.9 million barrels per day this year. So that should give a bit of a boost to tanker demand. And on the supply side, especially on the crude tanker fleet, the order book is really rolling off now. And by the time we get to 2014, there aren't too many uncoated Aframaxes or Suezmaxes due to deliver. And so that should help in terms of the supply-demand balance. So that concludes our update on the conventional tanker market for August 2013, and we'll speak to you again next month.